Imagine waking up tomorrow and all banks are closed. What would happen?
This can create immediate financial hardship for individuals. The ATM serves as a visual representation of this limited access. Individuals may face situations where they lose access to their funds. This can manifest as debit cards becoming unusable for transactions. Online banking services might also be rendered inaccessible. Consequently, individuals are unable to pay for essential goods. Access to necessary services is also restricted due to payment failures. This situation highlights the critical importance of maintaining uninterrupted financial access. A payroll freeze occurs when a business cannot access funds designated for employee compensation. This inability to pay employees has immediate and severe consequences for the workforce. One direct result of a payroll freeze is often immediate layoffs. Layoffs reduce the workforce, impacting the company's ability to function. The freeze also leads to a halt in production or service delivery. Overall, business operations are severely disrupted by the lack of available payroll funds. Supply chain disruptions occur when businesses are unable to fulfill their payment obligations to suppliers. This inability to pay causes the supply chain to slow down or stop completely. The halt in the supply chain leads to a lack of goods being delivered to stores. Consequently, store shelves become empty, and shortages of essential goods occur. The payment system experiences a complete breakdown. Electronic transfers become non-functional during the collapse. Check processing is rendered impossible. The inability to process payments leads to widespread defaults on loans and bills. A stock market crash is a sudden, significant decline in stock prices across a substantial portion of a market. This event is often triggered by widespread investor panic and a rush to sell off assets. The rapid selling leads to a sharp decrease in market valuation, wiping out substantial amounts of capital. Crashes can be precipitated by various factors, including economic downturns, geopolitical events, or speculative bubbles. The consequences of a stock market crash can be severe, impacting individual investors, businesses, and the broader economy. International trade halts due to the inability to process cross-border transactions. Banks are unable to facilitate the exchange of funds between countries. This disruption directly impacts global supply chains. The flow of goods and services across borders is severely restricted. Economic activities that rely on international commerce are significantly affected. The freeze in transactions can lead to widespread economic instability. Governments often implement emergency measures during crises. These measures aim to restore confidence in the financial system. One common approach is providing liquidity to financial institutions. Another measure involves guaranteeing deposits to prevent bank runs. Central banks sometimes print money to stimulate economic activity. This intervention aims to increase the money supply within the economy. One goal is to provide emergency funding to banks facing liquidity issues. Another objective is to support businesses struggling with financial difficulties. Printing money is a measure taken to mitigate economic downturns. An economic recession is characterized by a significant decline in economic activity. Businesses often respond to a recession by closing down operations. Business closures lead to a sharp increase in unemployment rates. Rising unemployment reduces the overall income available to households. Decreased household income results in a collapse of consumer spending. The combination of these factors deepens the economic downturn. Social unrest arises from widespread economic hardship. Job losses contribute significantly to this unrest. Depleted savings exacerbate financial instability. Lack of access to essential goods and services intensifies public frustration. These factors collectively trigger public protests and demonstrations. A bartering system arises as a direct response to the failure of traditional monetary systems. This system involves the direct exchange of goods and services between individuals or groups. Bartering bypasses the need for a centralized banking system or a common currency. It represents an alternative economic model often seen during times of financial instability. Digital currencies, such as Bitcoin, are becoming increasingly popular. This rise in popularity is driven by a desire for alternatives to traditional banking systems. People are also seeking alternatives to government-controlled money. Digital currencies offer a decentralized approach to financial transactions. This decentralization is a key factor in their growing adoption and use. Cybersecurity risks are escalating due to increased hacking attempts. Hackers actively seek vulnerabilities in financial systems. A primary goal of these attacks is to exploit weaknesses within the system. Compromised financial systems are particularly vulnerable targets. Sensitive data is at high risk of theft during these cyber attacks. The crippled state of the financial system exacerbates these risks. Emergency lending involves government provision of loans to struggling entities. These loans are typically directed towards banks and businesses facing severe financial distress. Government bailouts are interventions designed to prevent complete economic collapse. The goal is to stabilize critical institutions and prevent widespread economic damage. Such interventions aim to mitigate systemic risk and maintain overall economic stability. Deposit insurance protects savings up to a certain limit. This limit is the maximum amount the insurance will cover per depositor, per insured bank. If savings exceed the coverage limit, the excess amount is not protected. In the event of a bank failure, depositors may experience losses on uninsured amounts. Understanding coverage limits is crucial for managing financial risk. Depositors should consider diversifying their savings across multiple insured institutions to maximize coverage. A bank run is a situation where many customers withdraw their deposits simultaneously. Bank runs typically occur when depositors lose confidence in a bank's solvency. The rush to withdraw funds can quickly deplete a bank's available cash reserves. This mass withdrawal can create a self-fulfilling prophecy, leading to the bank's collapse. Bank runs exacerbate financial crises by undermining the stability of the banking system. Hyperinflation is characterized by a rapid and excessive decline in the value of a currency. This devaluation leads to a significant reduction in purchasing power for individuals. As a result, the cost of basic necessities rises dramatically. This makes it increasingly difficult for people to afford essential goods and services. The real estate market is experiencing a significant downturn. Property values are declining rapidly and substantially. Homeowners are facing a situation where their mortgage debt exceeds the value of their property. This is commonly referred to as being underwater on their mortgages. The collapse of the real estate market has broad financial implications. Pension funds are experiencing substantial losses due to market downturns. Stock market crashes are significantly impacting pension fund portfolios. Rising bond yields are contributing to the financial strain on pension funds. These investment losses pose a threat to the retirement security of many individuals. The stability of future pension payouts is being jeopardized by current market conditions. A credit freeze occurs when banks significantly reduce or halt lending activities. This restriction in credit availability severely impacts economic activity. Businesses and individuals find it difficult to secure funding for operations and investments. Consequently, borrowers may struggle to repay existing debts, leading to loan defaults. Widespread loan defaults can trigger bankruptcies and further destabilize the financial system. Sovereign default risk increases when a government struggles to repay its debts. This struggle often arises from declining tax revenues. Lower revenues make it difficult to meet debt obligations. This situation can lead to a sovereign default, where the government fails to pay its debts. Following the crisis, the government initiated regulatory reforms. These reforms aimed to prevent recurrence of similar financial events. Stricter capital requirements were imposed on banks. Enhanced oversight of banking operations was also implemented. Erosion of public confidence in the banking system can occur due to various factors. This loss of confidence often extends to the government and its regulatory bodies. A key consequence is the development of long-term distrust and skepticism towards financial institutions. Such distrust can have lasting effects on economic stability and public behavior. The video concludes with a message of hope for the future of the financial system. The focus shifts to the potential for rebuilding a more resilient and stable financial system. Responsible banking practices are highlighted as a key component of this rebuilding process. Effective government policies are also emphasized as crucial for systemic stability. The overall message underscores the importance of these factors in creating a robust financial future.